7:43. Welcome back to BT. Our favorite topic when you live here on the West Coast. Portfolio manager Bob Thompson back here on BT. Nice to see you.
Great to see you again.
The topic today, the top signs we are in a housing bubble. First, let's define what are the characteristics of being in a housing bubble.
I think that's important, Riaz, because if we stand back and look outside the Vancouver real estate market and just see how bubbles are formed and then see if this relates. So usually what you get is you get some sort of accumulation phase in which people say, wow, real estate is expensive or stocks are expensive or whatever the case is, and maybe I should hold off. Maybe I should wait for it to go down, and it doesn't. It just keeps going up. And then people say, okay, well, I probably should start to get in. That's what we call a wall of worry. And markets climb a wall of worry where people aren't sure and hold off, etc. Then what we get after that, and that usually lasts a few years, what we get after that is what we call a euphoria stage. And that's when people throw caution to the wind and they say, I just got to get in. I got to get in. Everybody else is getting rich. I'm not getting rich. And it turns into buying real estate like Black Friday at Walmart.
And you know, I think it's fair to say, looking at what's happening now, we're talking about the story of shadow flipping with these real estate techniques here in Vancouver, that our city fits this profile for someone that's anxious. Outside looking in, let's bring up the graph because, I mean, this data alone shows how things are moving at an astronomical level.
Right.
What is the reality for someone outside the market, hasn't invested and thinking, what should I do?
Right. You see the blue line on top there? That's basically Vancouver detached home real estate. And it climbed and climbed and climbed. And people have been talking about it for years. The real estate is expensive. People can't pay for it. And then we saw it go down in 2008 a little bit, but then it just continued right back up. And one of the reasons for that is because interest rates right now are at 230-year lows. They haven't been this low by many measurements since the late 1700s. So that gets people into real estate that maybe shouldn't really be buying a place, but because real estates are so low, our interest rates are so low, they can get in. Then what happens is you get that euphoric stage. So if we have the chart again there, maybe we can see that that last little stage is that euphoria. That's when it just pops up in value and prices go through the roof and people say, I got to get in, I got to get in. What you start to get in that last stage, and it usually lasts a very short period of time actually, is you get irregular sales practices. We've started to hear that. You get irregular lending practices, lax lending practices. You start to find ways for people to fit into things that they shouldn't do. You get people flipping. You get people changing ownership 4 or 5 times before the property is actually sold. And it's interesting because, you know, one of the first cases of this was in the 1600s, and it was called tulip mania, where one tulip bulb in Holland became worth more than everybody's worldly possessions. And it was interesting because I was reading these tulip bulbs would flip hands several times before the final seller actually got it. Exactly the same as what you see in any sort of market bubble.
Well, plenty of incentives, and you talk about these historically low interest rates. The dangers for people taking advantage of these interest rates and leveraging themselves during this phase of euphoria. What are some keys to keep in mind here?
Right. In any financial crisis, the people who get hurt the most are the people who are over-leveraged at the top. And we've seen that in the stock market in the last few years. The companies that are right on the verge of going bankrupt now, where they over-leveraged themselves a few years ago, and they're in trouble now. So the most important thing is you just can't be over-leveraged at the top. You can't extrapolate out that what's happened in the past 10 years is going to happen in the next 10 years. And you know, I was thinking about it last night, and my dad used to live in California, and they mentioned on the news one day, because everybody's moving to California in the 60s, they said, if this many people continue to move to California, as have moved here in the last 10 years, then in the year 2000, everybody in the United States will live in California, right, in the United States. And you said, wow, that's never going to happen. Obviously, we laugh at that, but that's what extrapolation does. And that's what the greater fool theory brings out. And the greater fool theory in euphoric stages like this states that you hope that there's a greater fool than you that will pay you a higher price than what you've paid so you can get out.
Best piece of advice right now, current state of reality for anybody out there, what would you say?
I would say never participate in a market where everybody's panicking to get into something, right? You don't want to participate in panic. Now, does that mean it's going to crash from here? Not at all. I'm not saying that. It may stabilize, it may continue to go up a bit more, but it's never prudent to panic into a market.
Well, this is a conversation that'll definitely continue. Bob Thompson, again, thanks for coming by and weighing in on this hot topic right there.